Berkshire Hathaway Chairman and CEO Warren Buffett joining us.
स्टॉक मार्केट रिलेटेड इंटरव्यू वीडियो पाने के लिए मेरे चैनल को सब्सक्राइब करें और बेल आइकन को दबा दें.
A couple of questions on that. First of all, does that mean you overpaid?
Well, we did overpay. We didn't overpay for Kraft. For Heinz. We bought that originally. It was a 50-50 deal. It's private.
50-50 deal with 3G.
Pardon me?
With 3G.
Yeah, with 3G. We had two stockholders. And then we overpaid for Kraft. And we wrote down $15 billion of that. And that, and that's the CPA's way of looking at it. Actually, the markets marked it down more than that, and probably quite properly. I mean, the thing to remember is, like, you know how the stock doesn't know you own it. You pay $10 for a stock, it goes to 8, and you think if it gets back to 10, I'll sell it. And if it goes up to 20, you say I can sell half of it and take all my money out. All those things are nuts. But in business, if we paid $7 billion for Kraft, which is all it takes to run the business, it would still earn the same amount as if we paid the $100 billion premium. The business does not earn more just because you pay more for it. And we not only, after buying Kraft, everybody started speculating about things we buy, so the prices of everything went up. And then on top of it, we paid large premiums for it, and we misjudged it.
I hear what you're saying about the house brands and the competition from places like a private label brand that Costco puts out. But what about just millennials changing habits? How much of it is that younger consumers don't want the brands that their parents and grandparents wanted?
There's some change in habits, but if you think about it, people don't really change their habits that much. If you try to think of the billion-dollar brands that have been created in food, and their private label there's very few billion-dollar brands being created in food. The fellow did it in yogurt, probably. I mean, but you don't really see that has not been a huge change. Physical volume hasn't changed much. The ability to price, though, has been changed, and that's huge.
We had an analyst on last week, on Friday, talking about what she perceived as the problems with Kraft Heinz. And she said she thinks they're underinvesting in the business. I mean, that's kind of been 3G's way to cut to the bone, and that's how you make this profitable. But she thinks the brands have been underinvested in. Would you agree with that?
I don't think so, but that's hard for me to tell. But I see, well, I was on the board. I mean, I saw lots of innovation on different products, and you saw them advertised to some extent. I do not think, but I don't know this for sure, but I think if you take the 10 largest food companies, I think in innovation, they've tried a lot of things, but how many things work? If you look at Kellogg and General Mills and go up and down the line, Coca-Cola, I mean, how many new products really become big? You read about them and all, but take Heinz ketchup. It's got 60% of the ketchup market. It's got higher percentages in other parts of the world, and it's a very, very, very strong brand. Philadelphia cream cheese is a strong brand, but other brands are weaker. And that you are right, certainly, that in certain categories, maybe in a Kool-Aid or Jell-O or something like that, they go back 75 years or something, and there's some secular trend against that, but that isn't the key. I mean, they cut costs not in innovation or in product quality or anything like that. They just took it out of SG&A, basically. Now, they may have made a mistake in terms of working. I shouldn't say we may have made a mistake in terms of trying to push hard against certain of the retailers and finding out that we weren't as strong as we thought we were.
Let's go to one of the questions from viewers, because we got a lot of questions related to Kraft Heinz. This one's number T5. Someone named JC Dominguez wrote in, is this the type of incident in time when you buy more Heinz, or do you pull the plug?
Oh, we don't pull the plug on it. I mean, we've never sold a share of Kraft Heinz. And if we sold or bought, it has to be reported within 2 days. So we wouldn't be able to do anything significant. But it isn't our our style. We are the partners with 3G on it, and so we have exactly the number of shares we had before. And you know, I guess I should never say never at age 88 in terms of what somebody else might do, but I can tell you I have absolutely no intention of selling. I've got absolutely no intention of buying.
Why wouldn't, if you're sticking with the business and it's 30% cheaper today, why wouldn't you buy more?
Because it isn't worth as much.
So you think it was a fair write-down that the market
at 35, you've got 1,200,000,000 shares out. So that's 42 billion for the equity, and we owe 30 or 31 billion. So the whole company is selling for 71 or $2 billion. And as I mentioned, it has about 6 billion of operating income. Now, for 6 billion, would you pay a lot more than 72, where it doesn't look like it's going to be going up for a while? Maybe even, well, they said it was going to go down in 2019. You know, there are other things I think where you get more for your money and better prospects. Not that I regard the prospects for Kraft Heinz as terrible. I mean, I would, if I had to bet one way or another, I think people will eat more of our products this year than last year.
But if you see better places to deploy money, why don't you sell?
You can't, well, we can't, as a practical matter, move around tens of billions of dollars that easily. But beyond that, well, it is, I mean, if we're working with $1 million or $10 million, would I have a position in it? No. You know, you move around with $1 million or 10 million, and Ted and Todd can move around reasonably well with 13, but that's going to be difficult. 173 billion. I mean, you dance like an elephant, not like some guy on Dancing with the Stars. We always have a sure winner, Joe. Last year, it's true the favorites got knocked out early, but we did split. There's a $100,000 consolation prize for whoever does the best. Now that got split 8 ways last year, but the year before we had 5 people that came within 1 game and just the last games of winning the $1 million prize. Now, if they'd won the $1 million, they would have had to split it if all 5 had won it. But there's a $1 million prize, and we're going to do it again this year. And we limit it to employees of Berkshire, but close personal friends of mine who have a brick also may be entitled to enter.
Joe, he invited you to enter last year and you didn't do it.
No. We were doing other things where depending. Let's do it again this year, Warren, with a Creighton versus Xavier thing, because they both have losing sort of records, and they're not doing quite as well. Although Creighton just beat Georgetown, and yesterday Xavier just beat Villanova. I don't know if you saw it. It was pretty good. So let's do something there. And let's see. There's a NetJet card I can think about. I don't know what the payoff's going to be, but let's see who goes further.
You can get another brick.
Exactly, if I'm lucky.
I get 30 seconds on the program versus a NetJet membership for you. Is that it?
Kind of.
I'll tell you what I'll do. I'll let you name the bet, and I will let you name the stakes, and we'll go from there.
Whoa.
Really?
This is the honor system, Joe. Yeah.
Okay, let's do that.
Now you're talking his language.
But he's very crafty and very smart. Like he sent me a NetJet card. It had my name on it, but it was absolutely useless. It was like it was like I use it as a luggage tag. It wasn't worth anything.
You said NetJet cards. You didn't say it had to work for actual flights.
That's a starter card. That's a starter card, Joe. We got big things in plan for you.
I do have great things to talk to you about. I'm worried. I mean, I think you think the market's expensive, Warren, so I want to talk to you about that. I mean, you don't like to say that, and you say long term it's going to be fine, but you've got a lot of metrics you're looking at there, like the market cap to GDP or GNP. That looks expensive there, right? I mean, there are things that look expensive, and you're having trouble finding things. So, you need to be honest with us about that. Is it really expensive?
The market, Joe, it depends on interest rates. We've talked about that before. If you tell me that 3% long bonds will prevail over the next 30 years, stocks are incredibly cheap.
Okay.
Because even, I mentioned that Kraft Heinz earns $6 billion on $7 billion of tangible assets. Even if you pay $70 billion and you earn $6 billion on it. That's better than having $70 billion out in 3% government. Interest rates govern everything. And if there were a way to short 30-year bonds and own the S&P for 30 years, I would give you enormous odds that the S&P is going to beat 30-year bonds. Now, we've had this period of extended long-term low rates, not only here, but around the world, and now it looks like we're not going to jack them up very fast. So we may be in a new world, the world that Japan entered back in 1990, and if so, stocks will, when we look back on it, will look very cheap. But, you know, this has not been the history of the United States to have these continued low interest rates. So if I had a choice today for a 10-year purchase of a 10-year bond at whatever it is, or 10 years, or buying the S&P 500 and holding it for 10 years, I'd buy the S&P in a second.
Well, that brings us to a question that a viewer wrote in. This is T67. Piyush Pant says, from the annual report in the 13F, it looks like Berkshire was the least active in the public markets in the quarter when the stocks were the cheapest. You also did fewer buybacks in the fourth quarter when Berkshire was cheaper. Was taking the foot off the gas in the fourth quarter a conscious decision? And based on what you just said, we got all these signs that look like the Fed was not going to be raising rates in the fourth quarter, too. So why wasn't that a buy signal for you?
Well, I thought stocks were a buy in the fourth quarter, just like they did in the third and second and first quarter. But sometimes we have other things in mind, too, that may use a lot of money, and sometimes they work out and sometimes they don't. But
what does that mean? You were holding your cash in case a deal came through?
We had at least one deal possibly that would have been very large. And so I liked stocks in the fourth quarter, but I would like buying a business even better.
Is that deal?
And incidentally, I did say in the annual report that we expect to be net buyers of stocks in this year. We have not been net buyers, I should point out. I mean, the market's gone pretty much straight up. I still think stocks are more attractive, but I have trouble buying it when every day it's up.
The deal that you just mentioned, is that potentially still on the books?
No.
So it's
I don't think it is. No.
Is it a deal here in the United States?
Yeah, is it bigger than yeah?
Is it bigger than a bread box?
I'll give you a hint. It's on this planet.
So you went out of your way in the letter to say that you do think buying businesses outright is more expensive, even though you don't think stocks are too expensive.
No question that, yeah. In stocks now, you have or businesses, I should say, you have a huge buyer, and that's not only, and companies are eager to buy too, but you also have private equity. And I don't know whether private equity, it's flexible because they can call on their partners for more money and all that, but let's just assume that they would have $1 trillion available. Now, they use a lot of leverage. They call themselves private equity, but they're really private debt, to a great extent. But that $1 trillion might buy as much as, say, $3 trillion of assets if it's leveraged with $2 trillion of debt. Well, the total stock market is something like $30 trillion. And if you take the top 5 companies, you knock or 6 companies, you knock $4 trillion off that. So you're down to something where the buying power of private equity, plus just the normal buying power from companies that want to get bigger, it's just a huge amount of competition.
When you start looking around, do you think the private equity companies are overpaying for this, or can they make it work?
They'd rather not. I mean, they obviously want to make the best deals they can, but they are in a game that is so much more competitive than it was for them. If you go back to the 1970s when leveraged buyouts started, which are the same thing they're doing now, but the name kind of lost its appeal there at some point. But the deals you could make then were enormously more attractive than the deals you could make now.
Let me ask you one more question that came in from a viewer. You've kind of answered this, but there may be a little bit more to the answer. This is T84 for the control room. Nick writes in, why didn't a large acquisition happen for Berkshire during the fourth quarter 2008 sell-off? Are you anticipating a much bigger decline in the market, or was I guess maybe it was the timing of it. Maybe it was so quick.
Yeah. Well, there too, in 2008, for example, we were going to buy Constellation Energy. We ended up buying the stock and making some money on it. But that was part of a deal. When Constellation fell apart, and it was in the fall of 2008, I was watching the tape. Dave Sokol was watching what was going on, and we practically called each other at the same time. And he was on a plane with Greg to Baltimore.
Greg Abel?
Yeah, that day, and we contracted to buy it. So we were ready to buy that, and we tried on other things, and but we participated in marketable securities big time at that point too, as you know. We spent, I think we spent $16 billion in 3 weeks, when nobody else was spending anything.
When was that? What?
Well, between about September 15th and October 7th or 8th. And then we already had another $3 billion committed to Dow, which was not going to get taken down till later on. So we went through our cash pile pretty fast, too fast actually.
You have a huge cash pile right now, though. What is it, $112 billion?
Yeah, we're.
And that doesn't even count the other $20 billion in cash-like.
No, that does count. I mean, but the 110 or something like
13,
that.
Whatever it was,
yeah, that counts 20. And you know, I never get right down to 20 anyway. But we've got a lot of cash, and we'd love to use it. But we're a private equity firm that's going to borrow 6 or 7 times what they call EBITDA, which I don't use as a metric. They're going to pay more than we are. And you know, as I said, we paid too much for Kraft. If you pay too much for something, it doesn't accommodate you by earning more money to make you look good. It earns what it earns. And if we'd paid $10 billion less for Kraft, it would have still earned the same money, you know, basically.
This question that comes in, this is F7 control room. Doug Wolford writes in, Warren, when you come across bad news on a holding, for example, Kraft Heinz, can you share the sequence of criteria you use to determine if the stock is on sale and buy or a bust and to sell? What really concerned you as to what is in back of a dip?
Yeah. The stock market is there not to instruct me; it's there to serve me. So, if there's bad news and the stock goes down, the question is, is the long-term valuation changed? And you know, there was certainly bad news at Geico when we bought it, for example, but there was bad news in American Express when I originally bought it back in the 60s. It was the best investment the partnership ever made. And so what you like is bad news about a fundamentally good business. And then you got to make sure that it's still a fundamentally good business. But no, bad news on a good business. We're better off because Apple stock is down significantly from where it was 4 or 5 months ago than if it stayed there. Apple will probably, they may not, but they have said they're going to go down to cash neutral. They could do it either by acquisitions or dividends or repurchases, and my guess is it'll be mostly repurchases. They're about $130 billion away from cash neutral now. If the stock were at 200, it would buy 650 million shares. If it's at 150, you buy close to 900 million shares. We're way better off, if it's at a lower price when they're repurchasing shares. Our partners are selling out to us, and they're selling out cheaper than otherwise. The worst thing that can happen from our standpoint with Apple is it sells at 230 or something like that, because we don't like buying it as well at that sort of price. The Camel, well, I was back at Geico 10 days ago, and the Camel was running well ahead.
Yeah, you should win some type of Mad Men or advertising.
Mad Men?
You single-handedly, turned that into, people need to do that. Geico, what the heck is a Geico? It's a government, it would have gone nowhere. But you ramped up all that ad spending, and look at it now. So, you really sort of, they owe you, the whole advertising industry.
Joe, I am so glad that you remember that I was the one that came up with the idea of Geico, the gecko.
That lizard.
People at Geico misremember that entirely. They think it was their idea, and I remember the days I sketched that little guy out and said, "Why don't we try the?"
That happens
I
on this
thought it was
show a
crazy.
lot. I know. We don't. Neither one of us get credit where we, that people forget what we do.
Yeah, I know that.
All right.
Yeah, well,
It's the heavy
our day will
lifting.
come.
It is. Hey, Warren, let's talk a little bit about what Joe was just talking about. And Joe, stay there because I know you wanted to ask about BYD. That might play into this. The trade talks with China.
Yeah.
How big of a deal is that? What have you seen on your companies, on your investments?
Well, I see the monthly reports from the companies come through, and a fair number, not in insurance at all, obviously, but a fair number of them the tariffs have had some impact. Now we're talking 10% tariffs, and a number of them say if it were 25%, there'd be some big adjustments. Some of it, the suppliers have swallowed over in China, and some we split with them, but it pushes prices up. I mean, there's no question about that. But it hasn't had a big effect at 10%. A number of them told me at 25%. I mean, the world changes. I mean, you either get a lot more money for your product, or you source it differently, or you do something.